There's something deeply satisfying about a checklist. You finish a task, you check the box, and you get that instant hit of completion. It's a psychological safety net, really. You followed the rules, you did what was asked, and you were officially in the clear.
Right. It feels great until you realize the boxes you're checking don't actually matter.
Exactly. What happens when the people checking those boxes are running the entire financial system? And the boxes themselves have absolutely nothing to do with whether the customer actually, survives the experience. Today, that entire tick box system is basically being demolished. But before we show you what's replacing it and how executives will survive this massive shift, I have a quick but very important note for you listening. Completing the CPD quiz associated with today's exploration will actually earn you a CPD certificate, and that is worth zero point 0.5 hours of general CPD points.
And I'd say a certificate like that is going to be incredibly relevant, especially considering how fundamentally the ground rules of financial compliance are about to change. I mean, we are looking at a complete rewiring of how risk is calculated.
Absolutely. Because today, we are focused on the Conduct of Financial Institutions Bill in South Africa, which is widely known as COFI. And our mission for you today is to understand how the financial sector is entirely abandoning that outdated static compliance model. They are replacing it with a rigorous, principles-based framework where the ultimate law of the land is the fair treatment of the customer.
Right. It's a massive shift from checking a box to actually proving a positive outcome.
Yeah, and to do this, we are looking through a stack of regulatory analysis and risk management reports that detail exactly how this legislation forces a change in corporate behavior. Okay, let's unpack this. Why is the whole regulatory architecture changing in the first place? I mean, we've had rules for decades.
We have, yeah. But those historical rules, they simply weren't protecting the end consumer effectively. To really grasp COFI, you have to look at it as the final piece, like the capstone, of South Africa's Twin Peaks regulatory model.
Twin Peaks, right. So this has actually started a while ago, didn't it?
It did, yeah. The heavy lifting for this transition actually started back with the Financial Sector Regulation Act of 2017. That legislation split financial supervision into two very distinct peaks. So on one side, you have the Prudential Authority, which sits within the Reserve Bank. Their mandate is purely financial stability. They make sure the banks have enough capital that they are fundamentally sound.
Right. Keeping the vault secure, making sure the math actually adds up so the system doesn't collapse.
That is the baseline, exactly. Then on the other peak, you have the Financial Sector Conduct Authority, or the FSCA. Their entire focus is market conduct. They care about how financial institutions actually behave, how they interact with their clients, and the integrity of the market itself. But here is the critical flaw that remained.
There's always a flaw.
Always. While that Twin Peaks structure was created conceptually in 2017, the actual laws governing day-to-day behavior remained completely fragmented.
So the regulators just changed their titles, but they were still enforcing this, patchwork quilt of old rules.
Worse than a patchwork quilt, honestly. It was an active liability. Market conduct was being policed by these legacy sector-specific statutes. You had the SAI Act for intermediaries, the Long-Term Insurance Act, the Short-Term Insurance Act, different rules for retail banks, different rules for friendly societies. This created massive regulatory arbitrage.
Hold on, let's clarify that. For anyone outside of the compliance department, regulatory arbitrage is essentially forum shopping for the easiest rules. Right? An institution could look at the patchwork, find the weakest set of regulations for a specific type of financial product, and intentionally build their business model around that loophole to just, avoid scrutiny.
That is exactly the mechanism, yeah. An insurer might tweak a product just enough so it falls under a less stringent act, bypassing the tougher consumer protections. COFI sweeps all of that off the table completely. It repeals or heavily amends those fragmented statutes and brings every single player, banks, insurers, asset managers, credit providers, and even the newest fintech innovators under one single unified conduct framework.
I was thinking about this legacy checklist approach, and it really reminds me of passing a driver's test. Under the old rules-based system, you get into the car with the examiner, you check your mirrors, you use your turn signal, you stop at the stop sign for exactly 3 seconds, you tick all the boxes, and they hand you a license.
Right, but you're not necessarily a good driver.
Exactly. The very next day, you could take that car out and drive recklessly, cutting people off and speeding. Technically, your license is still valid because you passed the initial static test. Under COFI, it feels like the regulator is saying, no, we're putting a driving instructor permanently in the passenger seat. They don't care if you checked your mirrors once. They are assessing if you are actually a safe driver every single time you are on the road based on the principle of safety, not a static checklist.
That analogy highlights the exact shift perfectly. It's moving from a static event to continuous operational reality. And this is where COFI completely shatters traditional operational risk management, or ORM. For decades, financial institutions anchored their risk frameworks to very rigid quantitative metrics.
Hold on. For those who aren't banking compliance nerds, when we talk about traditional risk metrics, we're usually talking about things like Basel III,
Mm,
right? Which is essentially the global rule book that dictates how much cash banks need to keep in the vault so they don't go under during a crisis.
that is the core of it, yeah. Traditional operational risk was defined by those Basel III parameters. So, system uptime, preventing external cyber attacks, stopping internal fraud, making sure transaction processing errors didn't happen. If the servers were running, the firewalls were up, and the daily ledger balanced, the chief operating officer was happy.
So the tech was the main focus.
Completely. But CFOFI forcefully expands that perimeter. It dictates that you must now actively measure corporate culture and consumer outcomes as hard, auditable operational risk metrics.
Wow, so you're saying a system can work perfectly from a technical standpoint, like it can execute millions of trades flawlessly without a single software bug, and under COFI, it could still be considered a catastrophic operational failure.
Without a doubt, if that technically flawless system is delivering a product with an inherently predatory fees structure, or if it's incentivizing a corporate culture of aggressive volume over client suitability, it is an operational failure under COFI. The regulator is assessing your position on a maturity spectrum now.
That's a huge pivot.
It is. You could have zero historical data breaches on paper, but if you have a reactive low maturity risk culture where you only fix customer problems after they complain to the ombudsman, the FSCA will intervene.
But wait, if the regulator is assessing my system based on consumer outcomes, I have a massive blind spot, don't I? Because once a product leaves my corporate lab and enters the real world, how on earth do I control what happens to the consumer? That brings us to product design. You can't exactly put a warning label on an investment fund like it's a pack of cigarettes and expect an independent broker to honor it out in the wild.
Well, they used to rely on exactly that kind of vague hope. But COFI introduces strict target market identification, or TMI. This is no longer some soft marketing exercise where the branding team says, oh, we hope young professionals buy this. It is a hard, documented operational control. At the design phase, long before a product is ever launched, the manufacturer must explicitly document exactly who the product is for and, critically, who it is strictly not for.
So if I build a highly volatile crypto fund or some complex derivative product, I can't just put it on an app or hand it to a broker network. I actually have to hard code my onboarding system to reject an 80-year-old pensioner from buying it.
Target market identification isn't a marketing suggestion, it is a digital firewall. If you design a volatile product with steep early exit penalties, your TMI documentation must explicitly state it is unsuitable for low-income consumers or retirees who need immediate liquidity. And those parameters must be hard-coded into the distribution agreements, the training manuals, and the digital onboarding platforms.
So it's baked into the very architecture of the sale.
Exactly. The system itself must inherently reject sales that fall outside of those approved parameters.
So the product manufacturer is held legally responsible if an independent third-party broker sells that high-risk fund to a pensioner anyway.
They are co-responsible, yes. And to enforce this, COCOM mandates continuous life cycle reviews and automated triggers based on real-world outcomes. Let's say a product hits the market, and suddenly there is a 10% spike in early-stage lapse rates.
Meaning customers are canceling the policy almost immediately after buying it.
Right. The institution cannot just wait for an annual compliance review to look into it. That 10% spike is a mandatory trigger that forces an immediate distribution freeze. They have to pause all sales and audit the onboarding disclosures to figure out why people are fleeing the product.
Because a high cancellation rate implies the customers didn't actually understand what they were buying in the first place.
Right, exactly. Or if ombud complaints for a specific product line spike by 15% quarter on quarter, that triggers an immediate root cause review to see if the product's fundamental complexity is causing systemic consumer confusion.
It's fascinating because it brings up a huge tension point about the accountability chain. It is one thing to design a perfectly safe product in a pristine corporate environment. But the reality of modern finance involves massive outsourcing. You hand that product off to independent brokers, or you outsource your client servicing to a massive third-party call center in another province. How do you govern them?
This is where we see the introduction of total accountability architecture. The legislation draws a very hard line. A financial institution can outsource its operational tasks, but it can never outsource its regulatory liability.
It is like franchising a restaurant. If you own the global corporate brand and you franchise a location out to a local manager, and that local manager starts cutting corners and serving spoiled food, the health inspector isn't just going to shut down the local branch. They are coming straight to corporate headquarters and saying, hey, you gave them the brand, you gave them the menu, you gave them the supply chain. You are responsible for the food poisoning.
That is a highly accurate way to look at it. Large banks and insurers used to rely heavily on indemnity clauses to shield themselves. If an outsourced administrator mishandled insurance claims, the parent company would just point the finger and say, well, that is a third-party breach. Go talk to them.
But not anymore.
Not anymore. Under COFI, third-party risk management requires continuous conduct-led surveillance. If you outsource a call center, you have to actively analyze their call sentiment trends, their customer drop-off rates, and their non-disclosure rates. You own the entire value chain.
And the consequences for failing to oversee that chain, this is where it gets incredibly personal for leadership. This isn't just a slap on the wrist for the corporate brand anymore.
Not at all. This introduces the hammer of the legislation, the key persons regime. Historically, if a company broke a conduct rule, the company paid a fine. The shareholder suffered a temporary dip in dividends, but the executives generally moved on with their careers. Under COFI, if there is a systemic conduct failure that traces back to a lack of operational oversight or a toxic corporate culture, the regulator pierces the corporate veil.
Let's drill into the mechanism of that. How does the regulator legally connect a distant call center failure to a CEO or a CO's desk?
The regulator looks at the data feed and the internal reporting structures. If that outsourced call center has a 20% drop-off rate, meaning angry customers are hanging up in frustration, and the chief operating officer never requested an audit of that metric, or worse, saw the metric and ignored it to save costs, the legal failure isn't just the dropped call.
It's the negligence.
Yes, the failure is the COO's willful blindness. That operational negligence is the legal mechanism that pierces the veil.
So they are held personally liable for the culture they allowed to flourish under their watch.
Yes. Failing to govern this chain leads to strict personal liability for executives, trustees, and operational heads. We are talking about statutory debarment, meaning you are legally banned from working in the financial sector, as well as personal financial fines that come out of your own bank account. It is a massive psychological shift for leadership when their personal livelihood is on the line.
Okay, here's where it gets really interesting. Because if I am an executive and my personal career and my own bank account are suddenly on the line because of how a call center agent treats a customer 1,000 miles away, how on earth do I practically monitor that? These are massive organizations with millions of daily interactions. Tracking subjective metrics like fairness across 1 million phone calls seems impossible.
It is the ultimate operational challenge of this new era, because under this regime, the burden of proof is completely reversed. The regulator is not going to spend years investigating to prove you did something wrong. You have to constantly supply data to prove to the regulator that you are actively compliant and treating customers fairly. And this exposes the single greatest vulnerability for established legacy institutions.
They're IT silos.
Exactly, they're IT silos. Over decades of mergers, acquisitions, and organic growth, big banks and insurers have built entirely separate tech stacks. You have the wealth management stack, the retail banking stack, the life insurance stack. A single customer could be a private wealth client, have a short-term car insurance policy, and hold a home loan, all with the exact same parent company. But because those legacy systems are siloed, the centralized risk team has no holistic view of how that client is being treated.
Which creates a nightmare scenario where an insurance claim could be aggressively, perhaps unfairly, rejected on one side of the business, while the wealth division is simultaneously calling that exact same client, trying to cross-sell them a high-fee investment product.
And under COFI, that systemic blindness is classified as a massive operational risk. You cannot prove you are treating a customer fairly if you don't even know what your left hand is doing to them.
So what is the defensive armor here? If human compliance teams can't read millions of emails and listen to millions of phone calls to save their executives from personal liability, the solution has to be technological, right?
It has to be cognitive technology. Forward-thinking institutions are deploying artificial intelligence as their primary defensive shield. They are utilizing natural language processing, or NLP, to continuously scan advisor-client emails, digital chat logs, and transcribed call center interactions.
What exactly is the NLP looking for? I mean, it's not just checking for spelling errors.
No, no, it is trained to parse sentiment and flag coercion. It looks for high-pressure sales tactics. Phrases like, "This offer expires in 10 minutes," or "You have to sign today or you lose the deal." It flags misleading disclosures in real time, long before a customer ever feels the need to file a formal complaint.
That handles the micro interactions, but what about the macro level?
On the macro level, they are using machine learning to detect systemic anomalies across the entire business. ML algorithms can analyze transaction patterns, lapse rates, and fee structures across vast client bases. They can detect if, for example, a specific demographic of customers is consistently being overcharged or is experiencing asymmetric product performance compared to another group. It takes the highly subjective concept of fairness and turns it into a hard, predictive data dashboard.
That is wild. It's essentially building a preemptive radar system for bad behavior. Now, we need to pivot to an aspect of COFI that is entirely unique to the South African context. And we are looking at this purely as a factual reporting of the legislative text. COFI isn't just about preventing bad behavior or implementing tech. It has a very specific, proactive socioeconomic mandate built right into it.
It does, and it represents a significant structural divergence from global regulatory templates. In most of the world, financial regulation focuses purely on consumer protection and market stability. HECO-I explicitly integrates broad-based Black Economic Empowerment, or BBBE, and the Financial Sector Code directly into the Market Conduct Licensing Framework.
Just to clarify the gravity of this for you listening,
Uh,
failing to hit these transformation targets, whether that's hitting financial inclusion goals or utilizing conduct-empowered vendor sourcing, is no longer just a missed corporate social responsibility target that gets buried in an annual report. From a purely objective legal standpoint, under SECOI, falling short on these integrated transformation metric could actually result in an institution losing its legal right to operate. It is a core operational risk metric.
Correct. The regulatory philosophy embedded in the text is that a financial sector cannot be considered fair or consumer-centric if it structurally excludes the majority of the population from equitable participation. So, for risk managers and executives, transformation has to be governed, measured, and audited with the exact same rigor as capital adequacy. But the legislation also recognizes that a one-size-fits-all approach to this would crush emerging innovation. Which brings us to the proportionality principle.
Right, because a massive legacy bank with a billion-dollar compliance budget obviously has different resources than a five-person startup.
Exactly. The proportionality principle deliberately lowers the initial compliance friction for small, agile, Black-owned fintechs and innovators. The regulatory burden is tailored to the size, scope, and complexity of the business. By doing this, it actively lowers the barriers to entry and drives market development. But for the large incumbents, this forces a massive strategic choice. They can no longer rely on prohibitive compliance costs to act as a moat to keep competitors out.
Because the upstarts have a smoother runway. So the giants either have to radically modernize their own clunky operational systems to compete with these low-cost digital players, or they have to build open finance architectures so they can safely partner with them.
It is a complete rewiring of risk. We are moving from a world of legal checkboxes, isolated compliance departments, and fragmented tech into a world of proactive, data-driven, culture-focused operations. The product itself and the entire chain that delivers it has to mathematically prove its fairness every single day.
And it is vital to understand the timeline here. While the framework provides a formal 3-year transitional horizon, that time is strictly a grace period for execution.
Yes, it is a window for migrating legacy systems, rewriting vendor contracts, and unifying data pipelines to secure that new activity-based license. It is not a window to debate the legislation or delay action.
The clock is ticking.
It really is. The institutions that wait until year 3 to start upgrading their tech silos or addressing their corporate culture will find themselves operationally stranded and legally exposed.
So what does this all mean for you? If you are sitting within a financial institution, or even if you are just a consumer observing this market, the shift is profound. We started by talking about the psychological satisfaction of ticking a box, of knowing you technically followed the rules. But COFI demands something much harder. It demands genuine integrity baked into the very code of the business. Which leaves us with a final thought to ponder. If treating customers fairly transitions from a soft PR concept into a hard, auditable data point, a metric that decides whether executives keep their personal bank accounts and institutions keep their licenses, What happens to the companies that realize this isn't just a regulatory burden, but the ultimate strategic differentiator? Will transparent, radically fair products simply become the new competitive premium in the market? Think about that. Thank you for joining the conversation today. There is true value in understanding the underlying mechanics of the world around you, and we're glad we could explore this one together.